Michael Hauser with Hauser Financial Coaching. Your primary residence is likely the largest purchase you will make. And if done properly, it is a great decision for your future. By buying a house, you stabilize your largest expense item and reduce it in the future when you pay off your mortgage. If not done properly though, a mortgage that eats up too much of your paycheck for too long of a period can cause stress and strain. So here's a guidance to help make the purchase of your house a blessing and not a curse. First, before buying a house, get completely debt-free. This means being free of all debt, including credit cards, car loans, car leases, student loans, and any other debt. Also, build up a fully funded emergency fund of 3 to 6 months of household expenses. These steps are very important because they reduce risk. When you own a house, you need to be prepared for the repairs and maintenance that are bound to happen. Within a very short time after buying my house, the hot water tank, sump pump, and refrigerator all needed to be replaced. When you are in the middle of an emergency like these examples, going into debt will turn the emergency into a crisis. By being debt-free and having a fully funded emergency fund, you can turn an emergency into an inconvenience. Once you are debt-free with a fully funded emergency fund, save up cash for closing costs and a down payment. Your down payment should be at least 10% for your first house and at least 20% for any house after that. With a down payment of at least 20%, you avoid private mortgage insurance, or PMI. PMI is a fee added to your mortgage if your down payment is less than 20%. PMI is a fee that goes toward insurance coverage that protects your lender, not you, in the event that you can't make your monthly payments and default on your loan. Also, a down payment of 20% reduces the risk of being underwater in your house. Before buying a house, make sure that you will live in the house for at least 5 to 7 years. The average cost to sell a house is about 10% of the sales price. Make sure that you are living in the house long enough to recoup these costs. You need to sell a house for the total of what you paid for the house, closing costs, and other transaction costs just to break even. If you are going to live in a house for less than 5 to 7 years, you are probably better off renting for now while saving up for a down payment. Both buying and selling a house working with a trusted, quality real estate agent is critical. If you are buying a $200,000 house and make a 5% mistake, it would cost you $10,000. You also need a good home inspector who will check the roof, house structure, HVAC, and more to help you avoid a money pit that would make you regret the house purchase. Do not waive the appraisal and home inspection. They are there to keep the buyer safe. If you waive them, you could be setting yourself up for a nightmare down the road. Get a conventional fixed rate mortgage with a 15-year term where the monthly payments are no more than 25% of your monthly household after-tax pay. This guideline will help you to become life rich instead of house rich and life poor. Also, 15-year mortgages have lower interest rates than 30-year mortgages. Let's look at an example of how to calculate your maximum monthly payment. In this example, the household gross income is $72,000 per year or $6,000 per month. Back out all of your taxes, including federal income tax, Social Security, state taxes, and other. In this example, we will assume the taxes are about 20%, but you can refer to your pay stub to get a more precise estimate of your own taxes. After backing out the total taxes of $1,200, your household after-tax income is $4,800. Multiply this by 25% and you get $1,200. This is the maximum payment that will include the mortgage, property and school taxes, and homeowners insurance. If you already own a house but are not within the guidelines we just discussed, don't panic. If you already have a 30-year mortgage, that does not necessarily mean that you need to refinance to a 15-year mortgage. In fact, if you would not decrease your interest rate substantially enough, refinancing would not be a good option. You can shorten the length of your mortgage by making additional principal payments as long as there are no prepayment penalties. If you already have a 15-year mortgage, but your monthly payments are 30% of your monthly household after-tax pay, but your income will be increasing in the next few years, you will be able to achieve that 25% guidance relatively quickly. And if you own a house, but you still have debt and/or you do not have a fully funded emergency fund of 3 to 6 months of expenses, that does not necessarily mean that you need to sell your house. You just need a plan to accomplish those two things as quickly as possible. I will help you build a plan to do just that. Click on the booking link below to schedule a free financial coaching consultation. In summary, I want you to own a house. I do not want a house to own you.